Welcome. My name is Arjen Mulder. In this short video, I'll introduce you into the cash flow statement. I will show you the concept of the cash flow statement by discussing the purpose of the cash flow statement, an explanation of the various elements, and highlighting why you as a non-financial manager should care for understanding. The purpose of a cash flow statement is to show the cash inflows and the cash outflows during a particular time period, usually the past 1 year. In that cash flow statement, we identify both the sources of cash inflow and of cash outflow, and we also identify the amounts of the three components of that net cash inflow, and those components are the operating activities, the investing activities, and the financing activities cash flows. Financial analysts, just like you might do, use the cash flow statement information to analyze the origins and the destinations of cash. This is particularly important for analyzing liquidity of a company. For you to also derive useful information from the cash flow statement, you should have a minimum understanding of that particular financial statement. So, what is it? In essence, this cash flow statement shows where the cash of a company once came from and where it went during the past period that we focus on. If we sum up all the cash inflows and cash outflows, we basically explain the change in the firm's cash and cash equivalents item that we observe in the balance sheet over that very same period. Let me give you an example. Here we have a cash flow statement of that hypothetical F&F Labs firm, where we can observe that there's cash in the three subcategories. Those are the cash flows from the operating activities, the investing activities, and the financing activities. In the next few slides, I will zoom in on these three categories, highlighting what happens with those cash inflows and cash outflows. Let me start off with the upper panel being the operating activities. In the cash flows from the operating activities, we typically see the cash inflows in terms of the cash received from clients. Bear in mind that this need not be identical to the total sales figure that you would observe in the income statement. In the income statement, namely, we plot the total sales figure, but not all money may already be cash. That is, if you currently sell something at a trade credit, you have already invoiced the client, there is turnover, but as long as the client has not paid, there's no cash received from that client. So this figure may be a little lower as compared to the figure that we would observe in the income statement. The same holds for any of the other items that we observe here. So purchasing services and goods for resale refers to the purchase of raw materials and services of third parties, but it only refers to the cash items. So if some of these occurred at a trade credit, they would not arise over here. Paying salaries and wages are all the cash expenses on salaries and wages, and in most GAAP systems, income taxes and interest expenses also arise in the operating activities column. Summing up all these cash flows under the operating activities header, we end up at the so-called net operating cash flow. For most firms, that number should be positive. Otherwise, the firm is losing money on its key activities. In this example, this hypothetical example, the number is negative, just to highlight that this should not be good. Let me move on to the next category, namely investing activities. In the investment activities column or category, cash inflows would typically arise if we sell off some fixed asset. So if a firm sells off a machine or a building, or maybe even a subsidiary. The cash outflows would typically arise if the firm would commit to investment in new investments. So it invests in machines or buildings, etc., or if it acquires other firms. CapEx stands for capital expenditures, and that is the investment or renovation of fixed assets. Summing up the cash in and cash outflows that we have in this category, we end up with the so-called net cash flow from investing. That leaves us with the third and last category, namely the financing activities. In the financing activities category, we have cash inflows if the firm commits to new borrowings, long-term or short-term, but also if the firm would issue new stocks. Those would all result in cash inflows. Whereas the cash outflows would typically occur if the firm repays some debt outstanding, if it buys back some stocks, and if it pays out some dividends. Summing up all the cash in and outflows in this particular category, we end up with the so-called net cash flow from financing. Next one we have is, now that we have discussed all the three categories, we can sum up the three subtotals. That is, in this particular cash flow statement that we have here, the first subtotal, which is A in parentheses, the net operating cash flow, plus B, the net cash flow from investing, plus C, the net cash flow from financing, that yields us the total net cash flow. For this particular example, this one is negative, suggesting that the firm has witnessed a decrease in total cash and cash equivalents. This is confirmed if we look in the current table at the item E, the penultimate line. The opening cash position for this particular firm would have been the balance sheet item cash and cash equivalents ending 2 years ago at 385 and ending last year at 330. The difference is perfectly explained by the total net cash flow. This is all there is for the cash flow statement. In this short video, we have had a look at the three categories of the cash flow statement, and the purpose was just to familiarize you with it. I look forward to seeing you soon in my Finance for Non-Financial Managers course. Thank you for your time and attention.